Hello. Today we'll talk about US crude oil and petroleum market, its main demand and supply drivers. Similar to my other presentations, this is just a short overview of its basics. Let's begin. Crude oil is a fossil fuel. That is a mixture of hydrocarbons that form from plants and animals which lived millions of years ago. Crude oil exists in a liquid form in underground pools or reservoirs, in tiny spaces within sedimentary rocks, and near the surface in tar or oil sands. The words crude oil and petroleum are used interchangeably, but they're not the same thing. After crude oil is removed from the ground, it is sent to a refinery, where different parts of the crude oil are separated into usable petroleum products, like gasoline, diesel, jet fuel, heating oil, plastics, and chemicals. However, refineries need more than just crude oil to make these petroleum products. This is where other liquids come in. Petroleum includes crude oil, natural gas liquids such as ethane, propane, butane, and others, biofuels, and other liquids derived from other hydrocarbon sources. For example, natural gas liquid butane is blended into gasoline, and ethane is used to make plastic packaging. A 42 US gallon barrel of crude oil yields about 45 gallons of petroleum products because of the refinery processing gain. World petroleum production grew by 1.3% on average during the period 1998 to 2025. The top 6 crude oil producing countries in the world in 2024 were United States, Russia, Saudi Arabia, Canada, Iraq, and China. Their crude oil production represented 56% of total world production. A unique feature of the crude oil market is the Organization of the Petroleum Exporting Countries, OPEC, that was founded in 1960 by 5 countries. Currently, there are 11 members in OPEC: Iran, Iraq, Kuwait, Saudi Arabia, Venezuela, Algeria, Libya, Nigeria, Congo, Equatorial Guinea, and Gabon. The United Arab Emirates left OPEC on May 1, 2026. The OPEC members control oil market prices by setting the production quotas. In addition, the members coordinate oil policies and ensure profitability for oil producers and stable oil supply for the consumers. In 2024, OPEC countries produced 36% of world's crude oil, but consumed only 9% of the world's petroleum products. The following chart shows top 6 petroleum producers and their consumption of petroleum products. As you can see, the United States is the largest producer and consumer of petroleum in the world. China is the second largest consumer. The United States and China account for 36% of total world petroleum products demand. Looking at the proven oil reserves, we can see that in 2023, OPEC countries accounted for 70% of total world oil reserves. Canada has the 4th largest oil reserves, 97% of which are the oil sands. As expected, the top crude oil exporter in 2024 was Saudi Arabia, followed by Russia, United States, Canada, and Iraq. The top importer was China, followed by United States, India, South Korea, and Japan. I continue by discussing US crude oil and petroleum market. In 2025, 5 states produced 74% of all crude oil in the United States. Texas produced 42%, followed by New Mexico with 17%, and North Dakota with 9%. Colorado and Alaska each produced about 3%. Crude oil and other petroleum raw materials get processed into petroleum products that businesses and consumers use. The bar chart shows 2025 US consumption of petroleum by product type. Motor gasoline used to drive automobiles, cars, trucks, and the like. and accounting for 43% of all petroleum consumption in 2025 in the United States. It is the largest petroleum product consumed. The second largest is the distillate fuel oil, which is diesel and heating oil. Diesel is used to power construction equipment, run trucks and buses, and in manufacturing. Heating oil is used in heating buildings by both residential and industrial consumers. Hydrocarbon gas liquids include ethane, propane, normal butane, and other olefins. These are primarily used to make plastics and chemicals. The jet fuel is self-explanatory. It's used to power jet engines in the aviation industry. Other category includes products like asphalt and road oil, kerosene, lubricants, and others. Next, let's look where demand for petroleum products come from. Transportation is the largest sector that consumes petroleum products, like gasoline, diesel, and jet fuel. Its 2025 consumption was 67%. The next largest sector is industrial, with 28%, which includes petroleum products used in manufacturing, mining, agriculture, and construction. The residential sector uses petroleum products for space and water heating, air conditioning, and cooking, and accounts for 3% of total demand. The commercial sector includes private and public businesses that use fuel to operate, like heating or air conditioning in the stores and post offices. Electric power is the smallest consumer that uses fuel to generate electricity. I continue by discussing crude oil and petroleum prices. Two most used crude oil prices are Brent and West Texas Intermediate, or WTI. Brent refers to crude oil produced in the North Sea and is a benchmark for two-thirds of international crude oil trades, including Europe, Middle East, Australia, and parts of Asia. WTI crude oil is produced in the United States and is a benchmark for Americas. The third benchmark price is Dubai Oman, which is used to price crude oil produced in the Middle East and exported to Asian markets. Recall that China is the largest crude oil importer in the world. Looking at all three price series for the period 1992 to 2025, we see that they exhibit the same trend over time. Let's take a closer look at the US benchmark, WTI. The chart shows monthly WTI prices for the period January 1986 to April 2026 in nominal and 2014 dollars. In nominal terms, with the exception of COVID-19 pandemic, crude oil prices have increased over time. WTI monthly average prices reached $133 per barrel in June 2008 before sharply declining as the financial crisis unfolded. Most recently, WTI reached a monthly price of $114 per barrel in June 2022. However, just looking at the nominal prices can be misleading. The prices of goods and services increase over time, but so do wages. Real prices are adjusted for inflation and allow us to compare how much more expensive things really are. For example, the price of $114 in June 2022 is about $91 in 2014 dollars, which is around the same level as the real price in September 2007 and July 2012. As a consumer, what matters to us are the gas prices at the pump. How are gas prices calculated? In addition to crude oil, the gasoline price includes refining costs, distribution and marketing, and federal and state taxes. The breakdown is provided in the chart on the left for March 2026 U.S. average gasoline price by Energy Information Agency. Crude oil accounted for 57%, or more than half of the gasoline price. Federal and state taxes account for 14%. Federal tax is fixed at 18.4 cents per gallon. State taxes vary. The chart on the right shows that California, Illinois, and Washington have the highest state gasoline taxes, whereas Alaska, Hawaii, and New Mexico have the lowest. Texas, the largest producer of crude oil in the United States, has a state tax of 20 cents per gallon. Take a look at the crude oil price chart from 1861 to 2025. It shows that major price increases and decreases are driven by global business cycles, expansions and recessions, natural disasters such as pandemics, wars in the Middle East, and technological advances. Next, I will discuss some of the more important demand and supply factors that affect crude oil prices. On the demand side, we have seasonal demand, economic growth, adoption of electric and hybrid vehicles, and exports. On the supply side, it is change in petroleum inventories, technological advancements, and OPEC production. The first demand factor we'll talk about is the seasonal demand for petroleum products. Gasoline demand is seasonal. It increases in the spring and summer as people travel more in warm weather and during summer school break. The demand is lower in winter months as people travel less for leisure. Gasoline prices mimic the same pattern. In addition, the cost of refining oil is high in the summer because of environmental regulations that require gasoline sold in the summer be less prone to evaporating during warm weather. Less evaporation leads to less pollution and smog formation. This requirement means that refiners must replace cheaper but more evaporative gasoline components with less evaporative but more expensive ones. The chart on the left shows the seasonal monthly pattern for the gasoline demand by the transportation sector and gasoline price. The pattern is similar for distillate fuels and diesel prices. About 80% of distillate fuels is diesel. Consumption in late spring, summer, and early fall months increases as diesel is used in construction and agriculture. Chart on the right illustrates this point. The second demand factor I will discuss is economic growth. When the economy is booming, consumers and businesses use more gasoline and diesel, and demand for petroleum products increases. People buy cars, take road trips, and build homes. Businesses manufacture more and use more of the petroleum products. When there is an economic downturn, the businesses reduce production or close completely, causing demand for petroleum products to go down. Take a look at the chart on the left. It shows the monthly transportation and industrial consumption of the petroleum products in the United States during the period 2000 to 2025. As was mentioned earlier, transportation consumption is cyclical. It peaks in the summer months and is the lowest in winter. Industrial is not as pronounced, but both sectors reduced consumption during the last three recessions. The chart on the right shows monthly crude oil prices from January 1986 to April 2026. For example, during the recession caused by the financial crisis in 2008, the WTI price dropped from the monthly high average of $133 per barrel in June 2008 to $69 per barrel in June 2009, or about half. People lost jobs and businesses closed, reducing demand from the transportation and industrial sectors, leading to lower prices. The third demand factor I will talk about is an increase in energy-efficient vehicles that use less gasoline and diesel. Transportation sector is the largest consumer of petroleum products. In the last 15 years, production and sales of electric and hybrid vehicles have increased, which for sure reduce consumption of gasoline. The concept of an electric car is very old, but commercial success is recent. The first hybrid car, Toyota Prius, was introduced in Japan in 1997 and worldwide in 2000. In the United States, the first hybrid sold was Honda Insight in 1999. In 2010, the first plug-in hybrid Chevy Volt and the first all-electric Nissan Leaf were introduced in the United States. In early 2020s, Tesla electric cars accounted for roughly 40% of all plug-in electric cars sold in the United States. Take a look at the chart that shows annual sales of electric hybrid vehicles and total light-duty vehicles from 2011 to 2025. The total sales of plug-in electric vehicles grew on average 50% per year during this period, whereas hybrid-only vehicle sales grew 19%. This is a large increase compared to the total light-duty sales annual growth rate of 2%. The share of electric and hybrid cars has been increasing over time as well. It comprised only 2% in 2011, increasing to almost 22% in 2025. The last demand driver I will discuss is the petroleum products exports. The chart on the left shows that US exports have been low and flat until mid-2010s. The dramatic increase is due to several factors. First, from 1975 to 2015, US government had a ban on nearly all US crude oil exports to protect against future oil crises. This ban was implemented after the politically motivated 1973 OPEC oil embargo, which banned oil exports to the United States and cut OPEC oil production, causing fuel shortages in the United States and worldwide. However, the shale boom, which I will discuss shortly, increased domestic production and alleviated major oil shortage concerns. Petroleum products transportation infrastructure also improved. After the ban was repealed, the crude oil exports increased from 300 million barrels per day in 2015 to almost 4 million barrels per day in 2025, growing annually at 28%. In addition, growth in US exports has been fueled by increased global demand, with a temporary pause due to COVID-19 pandemic, and the European ban on imports of Russian oil in 2022. In 2025, the largest importer of US petroleum products was Netherlands, followed by Mexico, Canada, South Korea, and Japan. Moving on to the supply drivers. One of the major factors influencing the price of oil is its inventories, specifically change in the inventories. Petroleum inventories are essential for market stability. They can be used in the future to even out seasonal demand fluctuations and temporary shutdowns of their refineries for maintenance or natural disasters. But too little or too much is when the price of oil gets affected. One way to assess if the inventories are building up is to examine the year-end petroleum balance, which is the difference between what was produced in the year and what has been consumed. If production exceeds the demand, the surplus will go into storage. But storage is A, not unlimited, and B, inventories indicate how worried we should be about running out of oil. So, if there is a surplus, it means inventories are being built up. The risk of running out of oil is lower, so the prices are being pushed down. The opposite happens when there is a deficit, meaning to meet the demand, the petroleum inventories will have to be drawn down, and there will be less left in the storage, causing prices to increase. The chart on the right illustrates this inverse relationship between oil, surplus, deficit, and its price. Similar to natural gas, advances in drilling and production technologies, or the shale boom, have increased US oil production, which in turn reduced crude oil prices. The two key technologies that are responsible for this progress are horizontal drilling, and hydraulic fracturing. Conventional, non-tight oil production generally means that crude oil flows to and up a well under the natural pressure of the earth. Tight oil refers to the unconventional production of crude oil from low permeability formations like sandstones, carbonates, and shale, using horizontal drilling and hydraulic fracturing. In conventional or vertical drilling, wells are drilled straight down into the earth. Directional drilling means wells are drilled at non-vertical angles. Horizontal drilling is an extension of directional drilling. When a well is drilled vertically to a certain depth, and then the drilling path is bent until it extends horizontally. Because horizontal wells are longer and the drilling process is more complex, they are generally more expensive to drill than the vertical well, but are also expected to produce more crude oil and natural gas. Hydraulic fracturing is performed after the oil well has been drilled. This technique is used to access the oil by breaking up the rock in the formations and creating pathways that allow oil and natural gas to escape from the rock layers. Hydraulic fracturing involves forcing water, chemicals, and sand under high pressure into the wells. Total U.S. crude oil production declined on average by 1% per year during the period 2000 to 2009, but then increased on average by 6% per year from 2010 to 2025. This growth spurt is all due to the increase in tight oil production, which went from being 3/10 million barrels per day in 2000 to 9.3 million barrels per day in 2025. The share of tight oil production has increased from 4% in 2000 to 12% in 2010 and to 68% in 2025. The largest tight oil production is in the Permian Basin located in West Texas and southeastern New Mexico. The next supply driver I want to discuss is OPEC. As I already mentioned, OPEC plays a large role in the global oil market. In 2024, OPEC countries produced 36% of the world's crude oil, but consumed only 9% of the world's petroleum products. In addition, OPEC accounts for 70% of total world oil reserves. OPEC sets production quota to provide stable income to producers, supply to consumers, and returns to investors. World crude oil prices are very reactive to what OPEC does. Chart on the right shows that for the last 25 years, OPEC production has been fairly flat, whereas non-OPEC production shows a slight increase in the trend, primarily due to the explosion of tight oil production in the US. In the past, OPEC controlled prices by setting production quotas for its members. For example, during the financial crisis in 2008, the price of oil dropped by 68%, from a high monthly average of $133 per barrel in June 2008 to $45 per barrel in December 2008. OPEC met 3 times that fall and cut production by 4.2 million barrels per day, or 12% of their total capacity. The shale revolution made OPEC look for different solutions in managing the global oil price. As mentioned earlier, U.S. production of unconventional crude oil exploded between 2012 and 2015. OPEC decided not to cut production. Instead, they wanted to flood the market with cheap oil, hoping to take shale producers out of the market since they would not be able to sustain the operation at these low prices. That, however, did not work. Instead, OPEC recruited Russia and few other countries to form OPEC Plus. The group agreed to its first cuts in 2016. In 2024, OPEC Plus accounted for 55% of all crude oil production in the world. Most recently, during the COVID-19 pandemic, crude oil prices dropped by 71% between January and April 2020. In response, in April 2020, the OPEC Plus called for a decrease in crude oil output by a combined 9.7 million barrels per day in May and June, and tapering it off thereafter. Non-OPEC partners also reduced its production in July 2020. In addition to OPEC Plus production quotas, crude oil prices also react to the OPEC spare production capacity. What is it? Spare production capacity can be brought online within 30 days and produce oil continuously for 90 days. It is an indicator of how well global oil market can respond to potential oil supply disruptions due to wars and natural disasters. Large OPEC spare capacity would suggest there is plenty of oil to bring online if needed, so prices stay low, whereas low capacity implies there is less cushion to withstand sudden shocks and price increases. Chart to the right illustrates this point. To conclude, I'd like to briefly discuss how one can hedge the price risk of petroleum products. One can use futures. There are two major crude oil products futures exchanges: the New York Mercantile Exchange, NYMEX, and Intercontinental Exchange, ICE. A futures contract is a commitment to make or take delivery of specific quantity and quality of a given commodity at a specific delivery location and time in the future. Most use futures on NYMEX to hedge crude oil and fuel price risk are NY Harbor ultra-low sulfur diesel futures heating oil, WTI crude oil, or RBOB gasoline. On ICE, it is Brent crude oil or low sulfur gas oil. One can also use options. Options are traded either on exchanges or over the counter. Over the counter means trade occurs outside the formal exchanges like NYMEX. Option gives the buyer or seller the right to take delivery or provide the delivery of an oil. A call option gives the option buyer the right to purchase the underlying futures contract at the strike price on or before the expiration. A put option gives the option buyer the right to sell the underlying futures contract at the strike price on or before the expiration date. Then we have swaps. A swap is an agreement whereby a floating or market price is exchanged for a fixed price, or a fixed price is exchanged for a floating price over a specified period of time. The instrument is referred to as a swap because the transaction involves buyers and sellers swapping cash flows with one another. Swaps are purely financial instruments. Lastly, one could use collars. Collars combine call and put options. You can buy a call option and sell a put at the same time, or vice versa. And here is a list of the sources I used to make this presentation. Thank you for listening, and hope you watch my other commodities basics videos.